Assalamualaikum and hi everyone. Welcome to my channel. In today's video, we are going to learn on how to prepare the consolidated statement of financial position for a simple group structure. And we are going to pick up a question which is from FAR320, final exam question, February 2022. For your information, I'm Madam Yusna Liza Hamid. If you are new here, welcome to the channel. If you are returning, welcome back. So let's look at the first question, which is the question on this preparation of consolidated statement of financial position that I will call C soft B. So let's look at what we have here. So it's about these two companies, Lana and the company being acquired called Lini. So we need to go identify who is the acquirer. And the acquirer will be the holding company. So this will be the holding company, and the acquiree is the subsidiary company. So subsidiary company here is the company called Lini, and the date of acquisition is on the 1st of January 2019. So this is the date that you will calculate the goodwill, and remember you acquired shares and debentures. So to get the detail on what was the consideration transferred on the shares and debentures in Lini, you need to check the information in the statement of financial position given. The statement of financial position given here is separating the holding and the subsidiary. So it's a separate financial statement. On the day of acquisition, you have the detail there. The reserve has a figure of you have the figure there, general reserve of 80,000, and the pre-acquisition retained profits of Lini for both situation is for Lini, so it's 50,000. And the year end of the company is the one given here in this question, which is as at 31st of December 2020. Before you proceed further, let us look at the requirement at the end of the question. What are you asked to prepare? So you're asked to prepare the consolidated statement of financial position, so the one here, and you are asked to show the also relevant workings for the year. Here is as at 31st of December 2020. So when you asked to prepare the consolidated statement of financial position, there are a few things that you need to do. You need to go and show, of course, the calculation of the goodwill and or maybe bargain purchase. That was number one. You need to show the schedule, which is to prepare the analysis of the group reserve, and the group reserve here will normally include retained profits and the general reserve together with the non-controlling interest. Here you can also prepare some workings as well. So apart from the reserve that are included in the schedule, so here is the schedule, you're also going to prepare the workings. So we can include here together with the workings and with some simple consolidation journal entries where necessary. And number three, you're going to prepare the classified consolidated statement of financial position, classifying the asset, liabilities, and the item here is going to be classified into asset, liabilities, and equity, right? So that is what you're going to prepare. And let's look at the information given. So you're going to, the function of the purpose of preparing the consolidated statement of financial position is to combine the asset of the subsidiary and the asset of the parent to be as of a single commercial entity. So therefore we are going to combine items like all the lands and building here, and we are going to eliminate any intercompany transaction. So these will all be combined, and going to also check for the intercompany transaction. However, this investment in subsidiary will not be included. Why? Because it will be eliminated on the acquisition date against the ordinary shares, equity, and the net asset of the subsidiary, especially the ordinary shares. The preference shares also will not be included because it will be eliminated against the non-controlling interests and on the calculation of goodwill. So we're also going to include all these assets, and that will be done in our template later. So I'm going to show you how to do the template in a short while, but before that, this will be included, but this will not be included because this will also be eliminated against the consideration transferred and the non-controlling interest. So when we talk about consideration transferred, this is the consideration transferred for each of the ordinary shares. So let me just take a different color. So this is for the ordinary shares that were acquired, and you will also have the preference shares that was being acquired, not all, just part of it, and also the debenture. You also need to do the calculation for goodwill for each of this. So we'll be doing that in a short while, but the function here is to prepare the consolidated statement of financial position is to combine the asset, liabilities, and equity. Apart from that, in this section, general reserve and retained profit, this one will be calculated later for the purpose of consolidation. We'll be using the schedule, and apart from having this, we're going to have additional item, which is what we call non-controlling interest later. So all this will be computed in the schedule, and then we're also going to add up all these items of liabilities and to be included that in the consolidated statement of financial position. But the reserve and the non-controlling interest will be done via the schedule. So what you can do is you can first set up or do a template which will have those items needed to get the marks, especially in the preparation of consolidated statement of financial position in the final exam. So here I have prepared some template for the calculation of the controlling interest for all the three acquisition of ordinary shares, preference shares, and debentures. I have also prepared a template for calculation of goodwill separately for ordinary shares, preference shares, and debentures, and also the schedule, which I have included here, where I divided that into 5 columns, where the first section or the last column here is the group general reserve, and here you have the group retained profit, here the NCI. In this section is the adjustment, and you need to include a few headings depending on how many subsidiaries you have. Here only one subsidiary, so retained profit of Lini, and then leave some space for retained profit of Lana, which is the parent, general reserve of Lini, and leave some space for general reserve of Lana. Then you can also prepare a template for the consolidated statement of financial position, where you have some lines for the non-current asset, current asset, and the equity and non-current liabilities together with the current liabilities section. So you can do that first, and you can do what you are most comfortable to start with. But I'm going to start with first calculating the controlling interest. To calculate the controlling interest, what we're going to do is we're going to look at what is the information given. So you have been informed that you acquired shares and debentures here. So to get the detail, you can check the one here. First, if you look here, 960,000 shares were acquired, and if you get the detail, the share capital in the subsidiary is given here in terms of the amount. This is the amount. However, if you want to find the units, it is not necessarily be 600,000. It can be any amount, but here it is given additional information A, 1.2 million. So you do the first calculation, which is to calculate the calculation for the acquisition of the ordinary shares, where you will take 960 divided by 1.2, and if you do that, you get this percentage here, and therefore you will have the figure, which is 960 divided by 1.2 million ordinary shares times 100, so 80% is for the controlling interest and the 20% is for the non-controlling interest. Next we go on to the second one. The second one is the acquisition of the preference shares. For the preference shares, I'll take a different color. I'll take this green, 160,000. And if you look here, the 10% preference shares, you have the information here in amount, but we are not looking at the amount, we're trying to find the units. So the unit is given here. In the first information, 400,000. So if you take the amount 160,000, the units, divided by 400,000, you'll get the second percentage acquired, which is going to be it will be the percentage acquired in the ordinary shares have been done. So preference shares, which refers to the 10% preference shares, that would be 40%, and this is 60% for the NCI. Done with that, now we go on looking at the third one. The third one is the acquisition of debenture. Okay, for your information, if you do not acquire any of the preference shares, that all belongs to the non-controlling interest. But in our case, we acquire. So same goes for the debenture. We acquire 80,000 of the debenture. And if you see here, the debentures in subsidiary was 400,000. So that is for you to calculate the percentage acquired. And the remaining will not belong to the non-controlling interest, but that will belong to the other debenture holders. So this is 20% here. So you are done with the first step, which is to calculate the percentage acquired for each of the acquisition. And this is the acquisition of the 10% preference shares to start with. Right. Now let's go and do the first adjustment, which is to start with the calculation of Goodwill. So after you have done this, calculate the Goodwill. So let's look at what will have effect to the calculation of Goodwill. Okay, you have number 2 there. Number 2 is information that is on intercompany sale of PPE machine, so that will not affect Goodwill. So we're trying to find out the information that relates to Goodwill. What are they? So you are going to find out what are the consideration transferred, the non-controlling interest, and the fair value of net asset. So fair value of an asset here, one of it is going to be this figure here that you have already been highlighted much earlier. This one, 80,000, that is part of the fair value of net asset. So fair value of net asset on the date of acquisition will include the pre-acquisition reserve. So not only that, it will also include this figure here, which is this 50,000, also on date of acquisition. And let's calculate the Goodwill by taking first the consideration as transferred in the acquisition of the ordinary shares. We're going to take this one, 1040, the consideration transferred, and that will be included in the calculation here. We include here the consideration transferred from the statement of financial position figure. Then we try and find out the non-controlling interest, but we cannot find the non-controlling interest if we do not know the fair value of the net asset. So let's find out the fair value of the net asset here. Okay, let's go and find out the fair value of an asset. The fair value of an asset on the date of acquisition will include the share capital and reserve on the date of acquisition. So let us just start with the first item, share capital. So where do you get this figure? This is from here in the section that you have here, which is only shares of the subsidiary. So here is the figure that I'm going to take, which is this figure here. Okay, this one, 600,000 is the fair value of an asset. The consideration transfer is 1040. And then again, there's one more fair value of an asset that will be included. Here is the general reserve and retained profit. So these two figures together with the share capital will be included in the calculation of the fair value of an asset on the date of acquisition. So I will include it here. Right, and you should also look for if there is any fair value adjustment which involve any surplus or deficit on the date of acquisition. But in this question, there is no revaluation surplus or revaluation deficit that arise on the date of acquisition. So we are done with the calculation of fair value of net asset, and we can calculate the non-controlling interest. So if you read further the question at the bottom here, you'd see that sometimes the question will inform of the calculation of the fair value of net asset and the non-controlling interest. So number 7 here, I'm taking into consideration this item, number 7, where number 7 is information regarding it was measured at the proportion of the fair value of asset, net asset, on the date of acquisition. So that's the reason that we find out the fair value of the net asset on the date of acquisition, so that we can calculate what is or measure the non-controlling interest. So there is no other calculation except for that. So now you can find the fair value net asset, where I put it as B, yeah, and you will compare A, which is the total consideration transferred, and the non-controlling interest. So therefore you will notice that A exceeds B, and therefore there's a goodwill for the calculation of the ordinary shares. Next, we proceed to the calculation of preference shares. We'll repeat the same, with the exception that we're going to take first the consideration transferred. So let's go and take the consideration transferred for the acquisition of the preference shares. For the acquisition of the preference shares, we're going to take this figure here, which is from here, this figure here. Okay, 160,000. Then we'll be looking at what is the preference shares that we acquired. Earlier we have acquired 160,000, which gives some how many percentage? Percentage is 40%. So let's do that first. Calculate that item. Then you include the figure there, 10%, 160. This is from the soft B under the column of Lana, and this is the 60% non-controlling interest percentage that you calculate here, the one here, and you will multiply with the preference shares in the subsidiary, 400,000, so you have 240. Then you will compare this figure with the percentage that you have acquired in the subsidiary. So basically the one that you acquire is 240,000, so the total now is 400,000 consideration transferred, with the non-controlling interest portion 60% percentage acquired by the non-controlling interest. If there are none, everything you don't have to calculate the goodwill, but here there is a non-controlling interest portion, so therefore you have the 10% preference shares here, balance taken from the soft B, the one here, this one, right, and therefore you will have the goodwill if there is any, but in this question none. So there is no goodwill, but you still need to check if there is any calculation of goodwill. We'll repeat the same for the 10% debentures, and let me inform you, in this question there are no goodwill for debenture as well, but we'll just repeat the same again calculation, which is to find out the consideration transferred for the debenture. The one for the debenture is the one here, this one here, 80, and the debentures acquired is referring to the one here, so you need to take percentage acquired in debenture. So take the consideration transferred, there is no non-controlling interest, bear in mind, and what you will do is you will just compare them with the percentage of the carrying value acquired in the subsidiary. So it was 20% from this calculation here, this one, and take 20% from the debentures in the subsidiary was 400,000, this 400,000, this one, right. Therefore you have no goodwill as well, so the total of the goodwill is still at the same figure, 456,000. And if you check information in the question, you are informed some last information there on impairment. So there was an impairment of 40,000. So if there is an impairment, you will be debiting the retained profit of Lana, which is the group, done for the group or the holding company there, 40, and you are going to credit the goodwill. So that will expense off some of the goodwill. So that must be later shown in the schedule under the column of the parent or the group retained profit. So you can see that now the unimpaired goodwill will be 416, and this will later be shown under the non-current asset when you prepare the Cs of P. So now we will move on to do this portion of the also preparation of the consolidated statement of financial position, which is the schedule. So I've already prepared this, but I will start off with the simple one first. I will include what are the non-controlling interests. So earlier we have already calculated the non-controlling interest on the date of acquisition. So you can find two non-controlling interests, which is the one here, this one, and the one here, second one. So that will be included in the calculation here. So I put in this non-controlling interest column 146 and 240. Now we proceed on other information that was given in the question, which is on normally on intercompany transaction. So let's look at the first one. So the first one here is number 2. I will be doing all the adjustment first, then I will, after I've done all the adjustment with simple journal entry, then I will show the transfer of that to the schedule. So let's do that step by step together. Okay, number 2, sorry, this one, 1st of January 2020. Remember the date of acquisition is 1st of January 2020, and you prepare the consolidated statement of financial position. The date of acquisition, sorry, is on 1st of January 2019. So after a year, you have the company Lini purchase a machine with a carrying amount of 460,000 from Lana for 500,000. So this is an intercompany sale of machine, PPE. So the seller, who is the seller? It was purchased from Lana. So Lana is the seller, and Lana is the parent company or holding company. Lini is the buyer. So if you, what you need to do is to find out if there is any unrealized profit on the machine, on the sale of the machine. So you are going to find this, and you are informed that our assumption here is that the machine that was purchased were not sold off to the outsiders by the end of the year, by the end of the reporting date. So the carrying amount is 460,000, and you would see that the selling price, the sales proceed was 500,000. You need to find out your machine or the profit here that need to be now being eliminated. So the unrealized profit will have to be eliminated, and the amount would be 40, and this must be on the date of disposal. So this is the date of disposal, DOD. So the carrying amount is given to you, so you don't have to calculate the carrying amount. So 40. So this is the unrealized profit. So the adjustment should be in the seller's retained profit. So you need to identify who is the seller. So you need to remove debit retained profit of Lana with that 40, okay, and then credit the item here is machine, machine. The buyer here is Lini. So how much? 40k. At the same time, you are informed that it is depreciated based on reducing balance method yearly basis. So what you can do is you take the unrealized profit to do the depreciation. Depreciation here is the depreciation that has been over provided. You need to find out the overprovision of depreciation, since you are selling at a profit. So we are looking at the seller to to do the adjustment for the our provided depreciation. So what you do is take 40,000, and you are informed it was 20% per annum, so 40 times 20%, so that will give you 8,000. And this over provision means depreciation has been over provided. You need to go and reduce the depreciation. If you reduce the depreciation, this must be done in the books of the buyer. So by the seller. So a seller should have done that because depreciation has been over provided by the buyer, but seller is the one that is adjusting the profit, the over provision of depreciation. You will debit the item here, machine, with 8,000, and you will credit the retained profit. Here the seller is Lana with 8,000. That must be included in your workings, so it will be included in the schedule. So we go to Lana, and we will be including it later, right? We'll be including it later. We'll have to include somewhere here. But what you can start is you can start putting the balance. Like you can put the balance as per the soft P given in the question. Where do I take that? I take that from the soft P balances in the question given. So let me show you, and you can also do that for Lini's section as well. So we can take it from here, which is here. Okay, this is for Lana and this is for Lini. Put that two figures in the correct section, and for Lini, remove this pre-acquisition retained profit balance. Remove if it's a profit, add if it's a loss. So that was what I did here. So you can follow me, and then you can do the adjustment later. You can do the adjustment, but I will be doing that in a short while. Yeah, you can start with that. You can also do that for the general reserve section of Lini, which is the easier part. Repeat the same that you did for your retained profit for this case of Lini, and also for Lana. You can do the simple thing first. Okay, you can just do it here. Right, so I took this from the question. Again, let me show you. This is from here. We take from general reserve 600, put under Lana section 400,000, put under Lini section in the schedule. And also don't forget to reduce Lini's figure with the pre-acquisition general reserve balance, like what I've done here. So you can do that, and for this part you are actually done, because there are no further adjustment, no bonus issue whatsoever. You will have the post-acquisition balance to be 320,000, and 64,000 will be the figure that you are going to include in the non-controlling interest. How do you get this? This is actually 320,000 times the percentage acquired is 20%, and this is 320,000. This is for NCI, and this one is for the acquisition by the parent. So 80%, that's how you get 256. Okay, that was for general reserve. We cannot do that for our retained profit yet. We need to go and settle the adjustment. So earlier on we have done the part on the calculation for Lana. Remember, the unrealized profit, and the calculation is the one I have done it here. So we just, this is going to be divided times is not okay. The percentage that was given for the depreciation was 20%. So I just do some correction to that. Okay, done. And remember that earlier on we did the calculation for our unrealized profit. All right, we have done that. Now we can go to the second adjustment, the third adjustment I mean, where this is on unrealized profit on sale of inventory. So identify who is the seller. So here Lana had invoice, and that happens after the date of acquisition, somewhere in the second year. First, the date of acquisition is 2019, so 2019, and that this one is 2020. So this happened here, and the year end is here, 31st of December 20. So at the end of that year, there was a sale. Seller here is Lana again, Lana, which is the parent company holding. Invoice goods to Lini at a profit of 40%. 40,000 worth of these goods are still remaining in the closing inventory. So number one, after you have done this, you need to go and find out what are the unsold inventory or closing inventory that is still remaining with the buyer. So if you can see here, the buyer is Lini, so 40,000 still remain in Lini. And now no information is telling you of whether this is unpaid or has been paid, so you assume no adjustment for the intercompany balances of trade receivable and payable. The next thing is for you to find out what is the unrealized profit on that unsold inventory. So you take 40,000 times percentage. Here you are given a margin 40%, so you have 40 times 40%, that will give you 16,000. And who is the seller again? The seller is Lana. You will adjust in Lana like what you have done here for a machine. You will now repeat for your inventory. So debit Lana, return profit Lana, and you will credit inventory with the unrealized profit of 16. Inventory that you are crediting is the one in the buyers. So we do that 16, and that must be reduced in the retained profit and also later adjusted in the soft P. But I will be doing the C soft P, the consolidated soft P later. I'm now doing the one for the adjustment under the unrealized profit. And let's do the unrealized profit for the case of unrealized profit of inventory. So this is the one here. Right. So you can include there the calculation as well. In case you do not want to do it separately, you can do the calculation there. Next, we do the next item. This is on dividends. Number 4 and number 5 is on dividends. So it's very important for you to identify whether this is situation 1, both subsidiary and parent have recorded dividend, or is it situation 2, subsidiary and has recorded, parent has not recorded dividends and debenture interest, or maybe situation 3 where the second situation just now is where both have not recorded the dividends and debenture interest. I repeat, the third situation is that the subsidiary has recorded but the parent has not recorded the debenture interest and dividend. So here you have number 4, directors of both companies have decided, so this is just being decided, to declare preference dividend for the year ended 31st December. So for preference dividend, this is actually situation 2, where both subsidiary and holding has not recorded. So what you need to do is you need to go and reduce the retained profit of Lini and Lana with the preference dividend, and on top of that, Lana has to also take credit of the dividends that Lini has declared for the preference dividend. So let's start off with Lana first to do what's supposed to be done by Lana as dividend declared by the parent itself. So for this one, number 1 is that you will debit the retained profit of Lana. Remember, Lana is the parent. So this is preference dividend payable. If you check, the percentage was 10% the dividends, and if you check further the percentage here, the dividend was to be declared based on this 800,000 for Lana and this 400,000 for Lini with the same rate. So I will put here 10% times 800,000. So you have here 80,000. Include this in the schedule. Alright, so later also include this in the SOFP under your parent liability. Number two is that you need to also do the recognition of dividend or declaration of dividend by Lini. Remember, Lini, you will credit the preference dividend payable. This one is for Lana, but this is for Lini, and this would be 10% times 400,000. Which 400,000? Again, is 400,000 here. Sorry, not here. The one under the preferences. And that was for 1 year, so therefore this is 40. However, you need to be careful that some of this dividend belongs to the parent. So you need to also recognize the share of the parent, since the parent has not recognized that. So parent will have to credit the retained profit with the share of the dividend. Remember, the share of the dividend in Lini, it is going to be based on the percentage acquired. So earlier on we have already calculated that the percentage acquired here, if you can check here, it was 40%. So we'll take that 40%, and that will be the case here for you to take 40% times 40,000 from here. So you get 16, and this is to be credited to the retained profit of Lana, meaning that this will appear in the schedule. This will also appear in the schedule, this figure, but the portion that will be credited to Lana is the one that is based on the percentage acquired. So you will debit the preference dividend from Lini. How much? The same figure, 16. So this is the one that you declare, but this is the one that is being shared by the parent. Okay, that was for the first one. And then let's look at the second one. Similar situation, debenture interest for both companies also have not been provided. So you're going to do exactly the same, but only with different figures. So we'll be doing that. I'll use purple. So for number 5 here, number 1 is that you're going to do the one for Lana, the retained profit of Lana. You will credit that with the debenture interest payable. You don't have to write in full, just write simple and shortcut 10%. How do I know it's 10%? Because this is also 10% here, and this is the debenture in Lana, debenture in Lini. So they both have the same amount of debenture, so you don't get mixed up. Lana will be 10% from 400, so this is 40. So this will appear in schedule of Lana. This will appear in the SOFP of under current liabilities. Second one, 5.2. I'm doing number 5 and number 4. You will now record the declaration of debenture interest by Lini, and that would be debenture interest payable Lini. Just now was Lana. So how much? That will be the same, which is 40 and 40. Why the same? Since it has the same percentage and the same amount of debenture. You can check that again here. Alright, next is to record the share of debenture interest in the subsidiary company. We have already recorded. Now we want to take the one of the parent. So this is 5.3, debit debenture interest receivable from Lini, how much. And if you have done the calculation much earlier, you would have noticed that this will be based on this percentage here. 20% the debenture interest, a debenture that you acquired, so that would be credited to the retained profit of Lana. 20% from 40,000, and that would be 8,000 here, 8,000 here. And don't forget to include this in the retained profit or the schedule later. Okay, this will also give impact to the consolidated statement of financial position, the one that we have already declared and also shared by the parent. I'll show that later. Now the last item is the item, I will be doing that later, but I will be doing this first. Bills payable that were in favor of Lana. So you are informed, or bills payable of Lini. Go and check bills payable of Lini. Go and check. This is 80,000, and you're informed all are related to Lana. So there are no bills payable related to outsiders. However, you need to understand that there were discounted amount there. So 80,000 is what the bill payable between group members, but 10 is the one being discounted. So undiscounted portion is what you are looking for. Undiscounted bills would be 70,000. How do you get 70? 80 minus 10. So you have 70. And this is the one that you need to adjust. Debit bills payable and credit bills receivable with the figure 70. But this will not affect your schedule. This will just give effect to the current asset and current liability in the soft B. Okay, and we can now finish off our workings and include that calculation here. You can put this side by side so it's easy for you. It looks it's doing this. Okay, I might just maintain this. So let's look at the adjustment. Remember earlier we just did the adjustment on dividends, so I'm going to do the adjustment under Lini first because to complete the schedule. So you can see that I've done the workings just now for information 4.1 and 5.1. If you notice, I've made that, and that is the only adjustment under Lini, the only two adjustment, and therefore you can find out what are the adjusted post-acquisition balance. It will be 550. There is no bonus issue whatsoever. If you have, you may have to adjust for that in case it uses the reserve like retained profit. So the one that you will divide to the non-controlling interest is 110, which is 550,000 times 80%, and 440,000 times 80% is that figure you divide to group retained profit. And this is 20% times 550 you get here, and this is 80% times 550. Okay, next one is to complete the remaining adjustment. Remember, there are a few things that you have done earlier which is on dividends and interest. So I'm now going to show the impact of that. We start off with the preference dividend payable by the parent. Here this is what being declared by the parent in adjustment number 4.1, right? 4.1 we did this, and then this is the one that parent took from the subsidiary in 4.3. Remember, I divide them into 3 adjustment. 4.3, right? Let me just show you where we just did it. This here. So here, just check here. You can screenshot this if you want to. Right. Next, you have that. That was the one that was credited by the parent. Next. Then you can see the debenture interest by the parents, by the subsidiary, sorry. That is the amount here. And this is the one that parent took from the subsidiary. I will color differently for that part. The one that was taken from the subsidiary. Right. So you take 40,000. You can also check the workings here again, this section. And the next one is to complete the calculation of the impairment of goodwill that we earlier did. Remember, there was an impairment of goodwill that were from this calculation, where I have also done the journal entry here. This one. Now we go and finish that off. We are done with that, so we can now divide the percentage acquired in the subsidiary. We have done that. So now the one under parent will be 616, right? This is the adjustment column. This is the final figure after considering all adjustment. And now you can now find out the total for the three columns that you have, 560. This is how you get them. Yeah, you have to do the adjustment first, then we can go and do that here at the bottom, the last part. So we can now do the adjustment for the addition of the assets and liability. We start off with the land and building, just add up because no adjustment for intercompany transaction, followed by the plant and machinery that has adjustment for unrealized profit. Remember, we debit the retained profit, we credit machinery, and that means we need to reduce the machinery. For the overprovision, I put here OPD, we credit the retained profit, we debit the plant and machinery. Next, you will have items for motor vehicle, no adjustment. Goodwill, you show here only the unimpaired amount. Then the figure here would be the figure that is in the current asset. Remember to classify them. Adjust for the unrealized profit for the inventories. Account receivable, there is no adjustment done for any intercompany balances of trade payable or trade receivable because that is not relevant here. You may come across that in other questions. Bank, there are no adjustment for cash in transit whatsoever. Same goes for inventory, no goods in transit. Bill receivable, what you adjust here is the undiscounted bills of 70,000. The total assets section would be 6658. You can now proceed with the equity. And remember, for the share capital, orange share capital is just the one of parent. Same goes for the preference shares, since the one of the subsidiary are being eliminated on the acquisition for both ordinary shares and preference shares respectively when you acquire to both the parent and non-controlling interest. Next is the reserve section. The reserve section here, the group reserve is comprising of group general reserve and group retained profit. We take them from the schedule. And same goes for the non-controlling interest, also coming from this schedule that you earlier prepared, 5601056. Right, there was some extra zero there, just correct them. All right. Okay. Next, you will do the next section, the non-current liabilities. So just add up and reduce with the amount acquired by the parent. For the current liabilities, the first section I will be doing for accounts payable and bills payable. Only adjustment for bills payable, no adjustment for accounts payable. And I will be doing now the adjustment that involve the intercompany dividend and interest. Number one, I start with the preference dividend payable by Lana. Remember, this is the one here. This one. So include that there, 80. Then proceed with the one of Lini. But the one of Lini, you need to go and remove with the intercompany. So this 16 is actually the intercompany dividend. So intercompany dividend is being eliminated, intercompany transaction. And next, where do we get this? This is for the one from here. Remember earlier was 40, and here you reduce. So when you reduce, what you reported is just the one relating to the non-controlling interest of 24,000. Next, you will continue with the one of debenture interest payable. There are no ordinary dividends being declared here. The one of Lana, remember it was from information number 5.1 that I've done the adjustment. And same goes for the one under Lini, number 5.2 and number 5.3. And again, this is the intercompany transaction again. Right, so let me just show you again. This is the one here, here, and here. So you will see that the figure here is 32, and with that you will see that the total will be 6.658 million, and this is going to equalize the total in the asset. That's it for our tutorial regarding the preparation of consolidated statement of financial position. I'll see you when I will see you. This is question February 2022. With that, I thank you for watching. Care to subscribe if you think this video will benefit you. Go and spread it to others. I thank you, and Assalamu alaikum.